Hello, I'm David Vickers, a Senior Multi-Asset Portfolio Manager at Russell Investments.
And I'm Owen Davies, an Associate Director within the Fiduciary Management team. Today we're going to talk about strategic asset allocation and whether there's a better way for trustees to manage their investment portfolios. So let's begin by setting the scene. Historically, trustees have reviewed their investment strategy every 3 years, typically in conjunction with their actuarial valuation. The purpose of this exercise is to go back to basics, focusing on what the primary objective is of the scheme. As schemes are maturing, usually this is to become fully funded on some sort of prudent basis, with the ultimate view to achieve buyout with an insurer. Well, what do these exercises do? We forecast what the expected cash flows, i.e. the pension payments, are likely to be, and then compare that with both the current investment strategy and a number of proposed strategies under a range of different scenarios. For example, repeat in 2008 or the impact of the Brexit referendum. Once the analysis is carried out, trustees then agree on an investment strategy, and this will typically involve fixed allocations to certain asset classes. This can be known as a strategic asset allocation and might involve having 40% invested in equities, 30% invested in gilts, and the remainder invested across a range of asset classes. So what are the potential pitfalls of this approach? Well, this approach doesn't usually account for a scheme's unique circumstances. Whilst outperforming a benchmark might have felt like success in the past, the world has moved on. The industry has acknowledged that even though you might have outperformed the benchmark by 2%, if that index is down by 27%, the portfolio has still lost a quarter of its value. The success metric should be directly linked to the scheme, linked to the scheme's funding level, and if the scheme happens to be in deficit, directly linked to closing that gap. This brings us on to governance budget. Most trustee boards meet at most once per quarter. Markets can and do move much quicker than this. If we take ourselves back to the EU referendum vote, the day after the referendum and that shock decision to leave the EU, the FTSE opened down 12%. Admittedly, it did recover around 8% of its value, but that's still a 4% move in a single day. And this brings us on to risk budgets. A fixed allocation to equity markets back in 2009, when markets were at all-time lows, looks very different now than having that same allocation to equities within your portfolio when markets look 2 to 3 times more expensive. Your strategy should be reactive to these changing markets and where we should best place the risk for the return that we need.
If your asset allocation policy is based on long-term forecasts and the consequent strategic asset allocation, then to us it makes sense just to question those assumptions and look at the fragilities of the model. So playing devil's advocate, I could argue that long-term forecasts are rarely right and they rarely change. Taking that second point first, rewinding the clock back to 2009, equity forecasters were talking about returns of approximately 8%. Today, they're talking about equity returns of about 7%. Not much of a change, given equity markets are 3 times as expensive as they once were. That certainly, to me, calls into the efficacy of those forecasted return numbers. Secondly, even if those return forecasts are right, they are an average, around which there is a very big distribution of returns. Returns are certainly non-linear. We typically don't get 7%, 7%, 7%. We might get 5%, 10%, 2%, minus 20%, and simply the average comes out at 7%. This is known as the error term dominating the forecast, i.e. the observable difference from the forecast is much bigger than the forecast itself. So this suddenly leads to a very suboptimal portfolio. The other issue is that in a strategic asset allocation, only those returns that can be forecasted are included in the portfolio. So for example, convertible bonds, which are very difficult to model because of the optionality embedded in the bond, often don't find a place in the portfolio. In addition, other asset classes like loans or asset-backed securities, where there is deemed to be insufficient historical evidence, so a long pattern of returns, also don't find themselves in the portfolio. And again, we think that is suboptimal. Finally, these issues are compounded by mean variance optimization, which puts the portfolio together. The variance optimization program looks at the forecasted risks and returns and correlation to other assets and takes it very literally. As such, this can compound the problem if forecasts are weak to begin with. For example, quite often commodities are deemed to have quite a reasonable expected return and a very low correlation to other assets. As such, the optimization program wants to allocate a significant amount of capital to that asset class. So let's look at the evidence that calls into question the efficacy of long-term forecasting. On the chart, we can see the distribution of equity market returns and here the US equity market return. Now, most of the modelling work and the data behind it was using data from the 1980s forward, perhaps arguably the golden age of equities. And what you can see on the chart is a relatively normal distribution. And it's certainly skewed positively because equity markets, as we know over that period, by and large, rose in value. When one looks at other periods, and we look at the period since then, it looks very different. We certainly start to get a distribution that is not normal, with wider tails. And then cherry-picking data and looking at the worst 20-year period in equity markets, starting just after the Great Depression, you can see a frightening distribution with large occurrences, frequent occurrences of large drawdowns, and to be fair, upside as well, but a very large, wide distribution pattern, which goes back to our point that markets are certainly not linear. Breaking that information down a little further in the table, on the left-hand side, we can see the actual returns that were gained by investors in the decades from the 1930s. And what you can see, even there, is quite a wide pattern of returns. In fact, 2 of the 8 decades surveyed here, you actually enjoyed negative returns. So 10-year periods where you actually lost money investing in equities. Now, given most defined benefit pension funds are now closed, or at least have a recovery plan with a defined time horizon, 10 years is a long time to go without that equity risk premium that was forecasted. Now, most equity forecasts embed an element of inflation. After all, you invest in equities for a real return. The far right-hand side of the chart shows those same nominal returns adjusted for the prevailing inflation rate of that period. It makes the returns even more skewed. You can see another decade goes negative and all returns are pushed down. So you now have 3 decades out of the last 8 in which equity returns have been negative. This certainly lends credibility to Nassim Taleb's quote that he's met rich businessmen, he's met rich speculators, but he's never met a rich forecaster. What we find when talking to clients is often that the burden of proof rests solely on those who propose a dynamic or changing asset allocation policy. We would advocate that the burden of proof should lie on your asset allocation policy full stop, whether it is static or dynamic. A static asset allocation based on long-term forecasting should not be the unchallenged default.
Many trustees have recognised the flaws with traditional asset classes, or rather fixed weights of these asset classes, and taken action accordingly. Over the last decade, we've seen increased use of diversified growth and absolute return funds. These aim to embed an element of strategic asset allocation within how the funds are managed, as opposed to trustees having to make these high-level decisions. More recently, in the credit space, we've seen an increase in use of what we call multi-asset credit funds. Here, investors are trying to capture the additional return available from credit, but conscious of the challenges of investing in a low-yield environment. Typically, these diversified allocations represent only a modest allocation within a scheme's investment portfolio. Traditional asset classes dominate both the outcome that the scheme will achieve and the pain that is experienced when markets fall. For most, the reliance on strategic asset allocation remains. We believe that the good steps already taken by many trustee boards could actually be taken further, moving to a new framework which moves away from strategic asset allocation. We contend that trustees should move away from the strategic asset allocation approach to set an investment strategy, instead employing a flexible approach which acknowledges the challenges and opportunities of real-world investing, an approach which is bespoke to your scheme and cognizant of your circumstances. We call this the required rate of return, and this is the return that you require from your investment strategy to achieve your objectives within the given time frame. This approach aligns interests. The advisor can only claim success if the target return is achieved. And if this does happen, all else being equal, the funded level will be improving and the deficit will be reducing. Success looks the same for all stakeholders involved in the scheme.
What we're certainly not advocating is that a dynamic asset allocation comes without risk. It does come with risk, a different set of risks. We're all perhaps very familiar with the investment cycle. What we show on this slide is the emotional cycle that comes alongside investing. If we take today as a starting point where we've had a number of good years of equity returns, we could arguably say the market is optimistic. Today, rationally, people are expecting a return for the risk they're taking. What typically happens as those return expectations are met, they increase as more and more people get pulled into the equity market, searching those historic returns that look so good. Markets often continue to appreciate because herding and momentum in the short term drives market. Markets start getting more optimistic. They start experiencing perhaps euphoria. And euphoria is where everyone expects equity market returns to be as good, if not better, than they have been historically. This is the point of maximum financial risk, but it is unseen by market participants because of the rampant level of optimism. As the cycle turns, we move to anxiety, perhaps denial, as expectations are not met. As markets continue to fall, people move into fear, perhaps depression, and start selling down some of their high-risk assets into more defensive assets, perhaps moving from small cap to large cap, from growth shares to defensive shares. Finally, this typically ends in outright panic and capitulation, where people are selling everything to cauterize the losses they think are coming and protect from further falls. This maximum point of selling, perversely, is when we have the point of maximum financial opportunity, and yet people are moving in the reverse direction. This is proven, and this is always true of markets. They are driven by cycles of fear and greed. It's why if you're trying to be dynamic in your policy, however you're trying to do it, one should be aware of these behavioural biases that beset markets. So what is required is a robust, repeatable, distinct framework to help guide you through to navigate those emotional roller coasters. It focuses the decisions in the right place, avoids the noise, and helps you avoid perhaps some of the traps that would otherwise beset you. Our process has a quantitative and a qualitative element to it. Quantitative because it allows us to strip out that behavioural bias that can be so destructive. But it also allows us to turn macro data into signals, assimilate a lot of information very quickly, and do scenario analysis. But as everyone knows, models are only as good as the past. They aren't as good with dealing with information or events they haven't seen before, or a confluence of events that they haven't seen in a particular sequence. As such, you do need a qualitative overlay. But as soon as you put a qualitative overlay on, you go back into the world of subjective analysis and arguably behavioural bias. So that qualitative overlay, we would argue, has to be governed by a robust framework that tries to strip out the worst of those behavioural biases. Our process has 3 main building blocks and 3 main time horizons. And it's the interaction of these building blocks at different time horizons and our conviction surrounding our judgment that dictates our investment policy. Very simplistically, it is valuation, cycle, and sentiment. We start with valuation. And what I would say is that even if you can't adopt a fully dynamic asset allocation policy, embedding a valuation conditional input to your long-term forecast radically improves the efficacy of those forecasts. Over 10 years, the valuation starting point dominates almost everything else. Clearly, buying something that is expensive, one would expect a lower return than if one had bought it somewhat cheaper. So we start with valuation, but we are aware it is a very long-term driver of markets. That said, it is also a short-term measurement of risk, because an expensive asset is a risky asset. We then turn to the cycle, which incorporates the economic cycle, earnings, and policy by central bankers and governments. This drives markets more in the short to medium term. What we are looking at here is whether the asset classes we're analysing are at the mercy of cyclical forces, where they are in the cyclical upswing or downswing of economic policy, growth and earnings, and where we are relative to market expectations. And finally, we have sentiment, which is a very short-term but very powerful driver of markets. We've already talked about momentum and how momentum can push markets up, so we take advantage of momentum. But we also embed shorter-term contrarian indicators to try and give us a sense of when markets are oversold or overbought, because we know markets go up by the stairs and down by the lift, and that diversification and dynamic asset allocation policy will help protect us when markets fall. Scoring and analysing and ranking every asset class through the lens of cycle, valuation and sentiment allows us to create a common language. It's quite often in investment divisions where somebody might say, I love emerging markets because they're so cheap. And someone else says, I hate emerging markets because I'm concerned about the economic cycle in China. Both of those statements can exist together. We can look at the valuation, score it relative to history and other asset classes. We can look at the cycle, score that, have a look then at how that economic scenario is valued in equity markets and where expectations are. It just creates a common language and focuses everyone on the right drivers of markets. Turning to diversification, as we said before, we think the playing field should be wide and every opportunity should fight for inclusion within the portfolio. And we call that capital tension. We do believe in diversification, but we do not believe in naive diversification, or at least a reliance on it. We know, we've had experience, we all have the scars on our back, that correlations trend to one during periods of stress, particularly liquidity-induced stress. The best case for defence is simply moving away from an asset class, perhaps than rather than moving down the capital structure. But as you can see, there are a lot of asset classes that should fight for contention. And clearly we talk about them in terms of risk, in terms of return, but also conviction. And importantly, that conviction should be relative to your required rate of return, as Owen talked about. It shouldn't simply be a relative decision. If we can achieve the return that is required with less risk, we will take that opportunity. We don't need to shoot for higher risk investments if your target is somewhat lower. And that's the important point, putting your required rate of return at the heart of your investment process and not a relative return static benchmark. So however you set your asset allocation policy, whether it is strategic through long-term forecasts or a more dynamic policy which changes to the changing market environment, one should ensure the process is robust, repeatable, and the efficacy is constantly challenged to keep it fit for purpose.
So in terms of key messages, we've suggested that there is a better approach than using strategic asset allocation to set your investment strategy. And we call this the required rate of return. Using a required rate of return allows trustees to set a clear objective which is both dynamic and responsive to scheme and market developments. Whilst all schemes are different, we do think that trustees should take as many steps as possible to align the interests of all stakeholders involved with the scheme's investment strategy. Holding advisors accountable for delivering the target return as, all things being equal, this is the single most important factor in determining success for a scheme. So in conclusion, we've suggested today that trustees should move away from using strategic asset allocation when setting investment strategy. We've suggested that using the required rate of return is a more accurate and scheme-specific approach. Whilst all schemes are different, we think that trustee boards should take as many steps as possible to align the interests of all the stakeholders involved with the scheme. This approach allows the trustees to hold their advisors accountable for whether the scheme achieves its objectives. That brings today's session to a close. Thank you for watching.
I hope you find that useful, and we're now going to open up for questions.